Good day, subscribers, and welcome into the Financial Education channel. If you're new here, I am Jeremy, and today I want to give you guys a video that you should get a ton of value from. We're going to talk about 5 stock market mistakes that you must avoid in 2019. I'm seeing a lot of people making these mistakes this year, guys, and I don't want you to get caught up in these mistakes because they're either going to cost you a lot of money in terms of you're going to make way less money in the stock market, or it will help you actually lose a lot of money in the stock market. So I want to share these with you guys, so hopefully you can avoid these. All right, I hope you get a ton of value. Make sure you smash that thumbs up button. And today's video is sponsored by my private stock market membership group. We're actually doing a deal here today for everybody that watches this video. It's going to be the pinned comment down there. If you're interested in joining that group, click the link and kind of check it out. All right, I don't want to spend 20 minutes going into why you should join that. I'll have that as the pinned comment. All right, let's get into this. Alrighty, guys, mistake number 1 I see a ton of people in the stock market making right now is they are not even paying attention to valuation of companies. And this generally tends to happen whenever you have the stock market really strong, which the last 3 months have been amazing. That was the strongest, first quarter we had for the stock market in terms of performance in I think it's like 2 decades or something insane like that, right? And when you have great times in the stock market, people stop paying attention to valuation and they start to primarily focus around growth. And what type of growth does this company have? What's the revenue growth there? What's the profit growth? Oh, who cares what PE it's trading at? Who cares what the forward PE is on this company? I just care about the growth right now. And that's where people's heads start to go. And it's like, guys, you got to remember, it's not just about the growth of these companies. It's not just about the growth in revenues, profits. It's also about what you're paying for that company, right? Everything has a value out there in the world, right? Let's say a Chevy Corvette. That has a particular value, right? It doesn't mean a Chevy Corvette is worth $1 million, right? The market says a Chevy Corvette's worth $50,000 or whatever it is, okay? Everything in this world has a value, including stocks. And just because it has growth doesn't mean you can pay an insane valuation for it. So you got to kind of think about valuation. I'm just seeing way too many people in the stock market right now specifically that are thinking way too much about the growth and not the valuation. And it's pretty funny because if we just go back to November and December, like literally, 4 or 5 months ago, everybody was like, oh man, I don't want to pay, look at the valuation of that company. I don't want to pay that. That's too rich, when the stock market was down and out. Now all of a sudden the stock market is doing great and people are like, don't care about valuation or something like that, guys. Like, this is absolutely insane, okay? So avoid this mistake. It doesn't matter if it's great times, bad times, anytime. Always pay attention to the valuation you're paying for that company, because growth rates can change. It happens with companies all the time. Economic cycles, come and go, right? Whether it's bad times or good times, or recession, or the economy's booming, or it's just average times, right? Things change, okay? Always pay attention to valuation and not just growth rates. Let's get into mistake number 2. Mistake number 2 you have to avoid in the stock market is investing in cyclical stocks at their peaks, all right? Cyclical stocks, basically what kind of stocks those are. Could be anything like memory chip makers. Those could be oil and gas type companies. They're basically any companies that are in a commodity related industry, all right? That kind of, has ebbs and flows, and it's not like these companies control their own destiny, right? Specific companies out there kind of control their own destiny. The Apples or the Amazons or Googles, those type of companies control their own destiny. They're not in commodity related businesses. However, there's a lot of stocks in the stock market that are in commodity related businesses, and steel stocks are a perfect example. And whatever's going on at that particular time, whether it's really good or really bad, people get too caught up in that and they think that's going to happen forever, when those industries can change constantly, okay? So for example, you see this cyclical stock out there, but you don't even think about it as a cyclical stock. You just find the stock and you're like, oh my gosh, look at this stock. It's trading at a 5 forward P. It is so low. Oh my goodness, look at the profits this company is making. They're just, pulling in the money left and right? And all of a sudden, a year or 2 later, that company that was at peak levels, that was bringing in, billions of dollars in profit or hundreds of millions of dollars in profit, all of a sudden is like break even, or actually is taking losses. And that's because with cyclical stocks, the industry can change in a snap of a finger. Things can go from really great to really bad. And that stock you thought you bought, you got such a great deal on at a 5, PE on it, all of a sudden now it's trading at a 10 PE because basically they're just not making nearly as much money or something like that, okay? okay? So don't get caught up into the trap of investing in cyclical stocks at their peaks. Just realize those stocks don't go up in forever. Believe me on that. And when they come down, they come crashing down. And sometimes you see these type of stocks fall 50+%. MU is a perfect example, right? May of last year, MU was flying high. It was like $64 a share. And in literally about a 6-month span, that stock goes from $64 to like a $30 stock, $29 stock. It fell over 50% in a matter of like 6 or 7 months, okay? That happens to a ton of these type of stocks that are very cyclical. People invest too heavy thinking they're going to just grow and grow and grow when they're not in the type of industry that they can control their own destiny. It's very reliant on what's going on in the market in general, guys. That's mistake number 2 to avoid. Let's get into number 3. Alrighty, guys, mistake number 3 that you've got to avoid in the stock market is investing all your life savings at once. I'm seeing a lot of people get caught up into this trap, and then I think the main reason why a lot of people are doing this is because we saw the stock market drop so much in November and December. We saw a lot of people, kind of stay on the sidelines during that time, and over the past 3 months, the market's just come back like crazy. We see a ton of stocks up 20%, 30%, 40% basically since their November, December lows, and all of a sudden that gets a lot of people thinking, like the fear of missing out starts coming in. They're like, oh my gosh, I got to invest all of my savings right now. I got, $10,000 saved. I got to get it all in the market right now. And I'm just telling you guys, like that's usually a very, very bad idea. And the reason being is you don't have any experience investing in the stock market, right? So if you're getting involved with the stock market, usually you like to play it a little slower, start when you have small amounts of money, not when you've got your life savings and all of a sudden you invest that money all at once, guys. That's usually a really, really bad idea. And that's how I see a ton of people lose a lot of money in a very quick amount of time. What ends up happening when those stocks go down? Their account balances go way down. Let's say they had 10,000, they invest all at once. Next thing you know, it's down to 8,500. They end up usually selling at very, very poor prices because they're not feeling confident. They're like, oh my gosh, I'm just losing all my money. What is the stock market, a scam or something like that? And that's a bad idea, guys. You want to invest slowly and kind of get your confidence right, okay? You want to get your confidence right. And then as your confidence gets right, you can invest a little bit more. You feel better about yourself and things like that. Don't just go out there and invest all your savings at once. I can tell you the stock market doesn't just magically double overnight or something like that, right? Sometimes the stock market has really bad times and sometimes the stock market has really good times. But most of the time, you can expect the stock market to go up anywhere from 8 to 12% in a given year. And that's the averages, okay? Most of the time, the stock market's not going to go up 20+%. And most of the time, the stock market's not going to go down 20+%. So if you're waiting for just those perfect times, it's pretty unrealistic because most of the time, it's going to be an 8 to 12% type year, okay, guys? So investing all your savings at once, usually a very bad idea. You're going to make very bad decisions, and you're probably going to lose yourself a lot of money, guys. All right, let's get into mistake number 4 to avoid. All right, guys, mistake number 4 to avoid is not averaging down on great stocks you buy. I see this time and time again where people will buy into a great corporation. That stock will actually go down in the short term, and they're supposed to be a long-term investor, right? They're supposed to be thinking years out. They buy into this stock. It goes down the short term for a couple months, and they usually don't buy anymore, or they actually end up selling the shares at very low prices. On some of these companies are just great companies that usually it's like a great discount if you can buy those shares lower. I can tell you from experience, like the majority of the biggest profits I've ever had in the stock market, many of them I actually averaged down. If we look at something like my public account, which everybody can see in my private stock market membership group, that account, almost every single stock I own in there, which is up on, right? Almost every single stock in there I averaged down, and some of them I averaged down several times. None of those gains came if I didn't average down on those great stocks. And I was watching October, November, December as stocks went down and down and down. I saw people selling at very poor prices. I saw people not averaging down on these great companies, the Apples and the Googles and the Facebooks and the Amazons or whatever, the greatest companies are out there. They were at, insane discounts. And people said, no, I don't want a piece of that. And a lot of the people had already invested in those companies. They went down massively. These people had money and they didn't, average down on their positions to get a way better discount on those shares, okay? It's like, I always give the analogy, it's like going to the store and you see this shirt and you're like, oh man, I really like that shirt. And, it's $25 today. I'm not gonna buy it today. Or you know what, actually, no, I am gonna buy it today at $25. And then all of a sudden that shirt comes up, tomorrow and you're like, I want another one of those shirts, but it's $10 now. It's not as good because it's $10. Like guys, that literally doesn't make sense, okay? That literally doesn't make sense. If you got great companies, usually it makes sense to average down. If you got really bad stocks, very speculative stocks, sometimes it doesn't make sense to average down because those are poor companies in the first place that you invest in. But great companies, most of the time, averaging down, you're going to make a lot of money in the end, okay? Especially if you did your full research there. let's get into mistake number 5. Alright guys, so mistake number 5 to avoid. I see this more than any other mistake basically in the stock market. I see this consistently year after year, and it's just a little different the way it plays out each year, okay? But it's basically judging yourself way too much off of what happens on a short term with a stock. So let's say you research a company fully, okay? You do all the research work necessary. You find this great stock, you get hyped on it, you're like, yes, I'm gonna buy the stock. You buy $500 of that stock, $1,000, whatever. And then let's say that stock goes up a bunch, you're like feeling yourself too much. You're like, oh my gosh, I'm the king of the stock market investing. This is so easy. Or that stock goes down and people judge themselves way too hard. And basically the back half of last year, I saw people judge themselves way too hard on their stock market investing decisions because stocks were going down and down and down. And so far this year, I see the reverse where people are judging themselves thinking they're stock market kings because basically the stock market's gone up here in the short term, okay? Basically, how you want to play this is judge yourself off a long-term basis. Whatever happens, great or bad. Like for instance, a lot of those positions that are, up huge in my, private stock market group, for instance, that private account, a lot of those were down big in November and December. I didn't go ahead and say, oh my gosh, I can't pick stocks or something like that. It was something I just had to deal with. I had to average down in positions, and then you make good gains on it and whatnot. So whatever time you're getting involved with the stock market, don't judge yourself too much off of short-term stuff that's going on, guys. Try to judge yourself off what goes on in the long term. If the stock went down over the first few weeks you bought it or the first few months, who cares? Okay, move on. And average down the position if it's a great stock, and learn and do those type of things. Don't get caught up into, oh my gosh, I suck at the stock market, or I'm the king of the stock market just because of something happens in the short term, guys. Judge off of the long term. Judge off of what's going on over the long term, and that's how you really can make a lot of money in this game over time, not what happens tomorrow or next month or next week or something like that, guys. So hope you enjoyed this. Hope you got a lot of value from this video. Make sure you smash that thumbs up button, guys, and share this video with anybody who's thinking about investing in the stock market or might be interested. All right, thank you for watching and have a great day.